Welcome to the next episode of Blockrevision. Today's episode will be complementary to the previous one, as today I will introduce you the section reflected to economy view, and right after market outlook and cryptos, and we'll end up at the sections that relate to economic calendar and trading idea. So let's begin. And starting up the whole economic world right now is commenting this 10-year Treasury constant maturity minus 2-year Treasury constant maturity yield, and it shows us that right now we have dropped below the dot-com bubble lows of minus 50 basic points, and that means that right now we are at the lowest levels been seen since 2001. This inverted yield curve has a tendency to point the future upcoming recession. Right now we may find that Powell is preparing for a kind of pivot, so they are expecting that due to this recession time yet to come, we would need to loosen our interest rates policy. That would mean that we'll start cutting interest rates, and furthermore push an economy into another possibly quantitative easing period. So for either it's for stocks, commodities or crypto, that might be a quite favoring time in terms of investments. Right now we can find that stock market, whether we are playing dovish or hawkish, may find that it's gonna be a little bit more chaotic and more volatile than even previous periods. As right now the eagles and the doves should fight for a possible fierce outcome that may lead to north or south direction for major indexes. So stock markets are on a mission to challenge Fed's policy as much as possible. However, Powell's and the team, and the biggest achievement by far is exactly this yield curve as looks like this here, and that's something that they cannot really brag about. And we are going into a topic that's also very loud of recent. That's Americans' household debt surpasses $16 trillion for first time, and it means that right now we are entering a territory, literally uncharted territory, that may lead to a very tough times for US customers. Right now customers and retailers are really piling cash, so that means they are preparing little by little for the oncoming hard times, but it also something that coincides right here is that those citizens might have a problems with paying down their debts. So that's $16 trillion for US is something that's really spooking many of economic analysts. Right now we may find that many economists are discussing over whether we might have a chance to get out of this very outstanding scenario for the markets we have been found in. US dollar has gaining its strength even after stopping up for a while. This rally, there's not very much of a sign that it may revert right from here. On the Euro USD chart, we may find that if I just turn it for a while, we may find there's no very specific kind of reversal right now. Something that we are forming on Euro USD is it resembling more like a bear flag than rather another pivotal moment around this parity levels of Euro to USD. And the only one chance for this one to bring in more attention by investors will be breaking out this channel to the upside, but right now we are still far away from there and consolidating within this area since second half of July. In terms of strong US dollar, there is something that also is spoken in many economies, because maybe the US would benefit from a higher USD because that lowers the cost of all imports, but in terms of other economies it means they need to pay their debts in a higher currency that has strengthened its purchasing power. Right now many of speculators are pondering whether we might get through 70s scenario once again, and getting back to 70s, we had a very outstanding recession time where the inflation in US were exceeding 10%, and heading back to that period, we may find that there are many of striking resemblance in relation to what is going on right now. Right here we can find that the inflation has risen very abruptly since early 70s, ending up in the middle of 70s, and this spike was really terrible. Back then the economy was completely different from what it's right now. There was more technology. Right now there is more technology and services. Back then was more agriculture and less industry. Also demographics and labor market regulations were different. But if we just have a look at those charts, we may find that something that happened back in 70s right now has a kind of a repeat pattern getting into recent months. So we have spiked US inflation that getting back to 21, and it happened due to this massive printing that has been made by Fed, but back then in 70s this scenario happened right after dragging out this US dollar gold parity, and either this or that situation stems from devaluation of currency. So the backgrounds of those two economic phenomena is right now getting us into some of a resemblance, and especially with inflation versus wages gauges, there are also some of the similarities. So does it mean the Fed may need to crash the economy as it has done back in 17th in order to tame rising prices? There's not obvious questions, as back then major indexes were in different positions. Declines in the period of 73 to 74 and amounted to 50%, and PE was around 8 points, whereas right now it's around 19. In the low 74th, S&P 500 adjusted for inflation was 48% below the 90-year linear trend. So right now it's above 70. So that would mean we might bring back some of the factors that led to specific Fed's actions. However, we can't really put it one to one. In order to forecast, we may find that heading into forecasts extending for more than 6 months ahead, we have a very low rating of successfully forecasted projections for the economies, whether it's for BOE or United States. So right now I would like to point to different elements of the economy, but need to emphasize that neither of them can have 100% I would say the preceding power that may tell us straight ahead in which direction the economy is heading. So US heavy truck sales right now is in a good zone, as I would claim it. Right now we are still far away from those lows back to GFC and dot-com bubble. Right now we have slumped during this post-corona crisis for the about 1 month. It was a very short period of time, but as we can find right here, we are consolidating within this quite of a neutral territory. So the market is expecting the Fed to beat inflation drum. 50 basis point rate hike reasonable next month, and that's something that is priced in. However, we still expect in some scenarios to have it at even higher levels, whereas there are some projections that Fed may rise their estimates after having the economy go in the right direction, whereas inflation not stopping up. Fed's Kashkari also has convinced us that some financial markets are indicating they expect cut interest rates next year, but he has summed up that he doesn't want to say it's impossible, but it seems like that's a very unlikely scenario underlying inflation dynamics. So they will watch the economic gauges quite carefully, but there is no certainty in any of the stances. Bank of America expects that PCE for the next period of time will GDP projection will lower in by the end of the year, but it will recover the next one. Yeah, that's the rate hike expectations at the low levels. However, regarding this GDP, that's been shown by and presented by Goldman Sachs, we may find that stronger economy is something that may push Fed back towards more hawkish position. Right here we have a very interesting point of view where we can find that stock investors better hope a recession has started, just because we could find that not one this publicator said can prove that with detailed analysis of data is that efforts to delay and soften the pain of recessions make them last longer and do less clearing out. So it means that whenever we are trying to postpone the crisis and by, I don't know, introducing just some poor measures into economy, we are just really praying for bigger disaster to come. So it would be much better to fall quickly and stand up firmly rather than just postponing its outcome into infinity and afterwards suffer a real tornado. In terms of something that may stop up the possible recession, is that S&P 500 companies are still sitting on cash. That's something that hasn't been seen in previous possible recessions, so that means this exactly recession, that's another one that might be really delayed in time. So recessions are right now maybe a little bit been put further in a perspective of time horizon, but we may take a notice on that. There's not free lunch and we may still be heading into a some economic difficulties. In terms of market outlook, we may have found that revision breadth is down, and there is some projection that earnings will follow, whereas we can find that the market is started to clear out itself by hedge funds that already has started to bring negative results. So whenever fresh money is flowing into the markets, this very very intelligently managed hedge funds are generating profits, whereas the money is flowing out, this very intelligently managed hedge funds are generating losses. So that's very funny, and that's why you might have a possibility to consider investing by yourself or otherwise investing passively into some kind of ETFs that has lower fees of management. Right, this one article was discussed by me in some cases into going into crypto outlook, and we have found that another disaster has entered the crypto market. Binance KuCoin, OKX CEOs flag security amid Solana FAT storm, and that means there was another hack. So a hacker has stolen the crypto coins from around 7,500 hot wallets. That's why you need to consider, if you're using cryptos, need to consider using a hard wallet. Whether those losses will be compensated and the funds will get retrieved, there is not sure as of yet. Maybe there will be kind of white hat hacker that will have their his funds return in some time in the future, but we may just pray for such an outcome. Maybe Solana's fund may pay down some of the losses, but I don't really find that it may happen in the nearest future. So that's a very, very bitter lesson. In terms of positivity, I do find that right now BTC got through a next difficulty, next rising of difficulty of a network, and within which we may find that now this June of 2022 has commenced a kind of a period of miners capitulation, another capitulation within this cycle, and those hiking difficulties, mining difficulties, may just lead to another more troublesome conditions for these miners to maintain their network servicing, and that means that more and more miners may drop out. After this relatively low Bitcoin price on the market, it really needs from miners the very low price of energy that they should use in their power mining equipment. So without this, I do find this time ahead as a very difficult for many of them. In terms of market movers, we already had today Bank of England's decision, and they raised as expected by 0.5% more, and that means that many of central banks is following their previous guidance that been set in first and second quarter of this year. So the economy is right now developing as expected. In terms of balance of trade by Canada, right now we are going through, that will load up. We are going through much more positivity, within which right now Canada is some of the country that is going to throughout the crisis much better than their peers from United States. So in terms of economic calendar, tomorrow we have very important non-farm payrolls that is also highly expected to bring around 300k units. In terms of earnings, we already had Alibaba that has turned out positive, surprised by 16%, and it concluded to a price change of around 2.2%. So it means the market was surprised by not very much, but this surprise was positive anyway. So in tomorrow's earnings day, we may find there will be very interesting Berkshire to watch, and also Canopy, that also very interesting by some of especially new investors that entered up the market in 2021 and got interested into this Canopy markets. In terms of trade idea, I have for you the interesting for me gold to USD. market. Right now we are just heading towards this very important resistance of around 1800s. That's not only psychologically important zone, but also very interesting in terms of previous supports. Right now the support is expected to become a resistance, and that's why I do expect the rebound from here, especially after painting this strong bullish candle on gold. That may appoint a local top, local euphoria that should bring down prices in the first half of August, the rest of the first half of August. So I would expect this price to revert somewhere around the levels of 1800s, and that's why I would watch the gold. If the gold would hit the levels that are expected, I would possibly hold the put positions right from 1800s back to around 1700s. Alright, so that's kind of the maybe a little bit superficially, but I would say the outlook of what I wanted to introduce you has been really included, and that's why I'm leaving this for today's episode. If you have any questions, just put it in the comment section below the video. Thank you very much for watching, and see you tomorrow.